So those are just some of the thoughts there that we have. We covered that for Alton and related to the credit spreads and the debit spreads about SPX. There's nothing wrong with doing it. One of the tools that we have, of course, is the spread chain tool, Alton. And what I can do there, here's QQQ. If I wanted to look at just credit spreads, I can tell the system just to find me credit spreads on QQQ that let's say have a, let's say 2% spread width, or 2-point spread width, I'm sorry, minimum 20-cent net credit, probability above 80. Okay, and there's not much out there. Let me go to the standard expiration here. That's only 7 days out. Okay, so we're not seeing a lot of calls there in that case. Let me drop the return down to 3%. But again, NDX is not showing us a lot of good bear call combinations here with a minimum net credit requirement. Let's drop it down to 5 since we changed it to a weekly. There we go. So what you're seeing here are bull puts on this side with the probability range you want, the return. Yeah. So here's a good one, 7 days out, 85.6% probability, 11.1% return. That's not too bad at all. And on the bear call side, 9% return with an 83% probability. That's not too bad either. This tool can help you in that case. And, Alton's follow-up, I want to go to radioactive trading here to answer Alton's other follow-up question there that he had earlier, since we're on the spreads right now. Looking at a credit spread or a debit spread. Now I'm going to talk about out-of-the-money credit spreads first, which is the same risk-reward I'd look for that in-the-money bull call debit spread we just covered sort of for Terry. And what I want is a good probability of 80 to 85%. Usually my preference, as you saw with the bull put weekly screen we just shared, I'm looking for an 85% probability or higher. I still want to try to average about a 15% return, but I'm going to use those exit triggers I mentioned and stop the positions from getting more than a 50% loss. That's 50% of the maximum loss. So if I got a 20-cent net credit on a 2-point spread, my maximum risk, of course, is $1.80. My liquidation loss hits 90 cents. I'm closing that position because I don't want the loss to get higher than 50%. And why is that? Well, not only just in actual testing, but in actual trading, but a step lower than that helped guide me to the direction I want is this trade simulator tool that we show on Power Options. I want an average return for my credit spreads of 15%. I'm going to control my loss of what I invest into each credit spread, the margin requirement, the difference in strike prices of 50%. This is probability of loss, not probability of winning. So I'm going to set a 15% probability of loss. I'm going to take a $10,000 account and I'm going to allocate 33% to each trade. Now what this tool does is going to flip a coin 100 times. And heads, I win, I make 15%. Tails, I lose 50% of what I invested into that spread position. In this case, 3,300 into 3 different spread positions. But each one is an individual trade. And then it runs through and flips the coin. And it shows me the expected return with the wins and losses. Now, so this is here, I want to get closer to 85, 84%. 86 is pretty, there we go, 84. Okay, so this is what I commonly expect to see. If I start out with $10,000 over 100 trades, about an 84, 85% success rate is what I'm looking for, I have to expect that at some point, the portfolio is going to be down 30%, 35%. One point, it was even down 50%. You've heard me talk about that before in other presentations, that February 5th through 9th of 2018, sudden movement, the China trade war and everything, when the market just pulled down quickly, I had 3 spreads that within that first day or two got into a 50% loss on the position. Okay? Let me keep everything the same, but let me allow the losses to go up to 65%. Hey, it moved against me, but I think it's going to come back. I don't care if it's at 50%. I'm going to wait for it to come back up. So let me go to 65. 82% win ratio, 70% loss at one point on the portfolio, and a losing value of almost 30%. 9100 being right 83% of the time. 85, still you start to see a reasonable profit again, but you need to be right 85% of the time. But think about how different that is. Let me get back to, I would just try to get to 84. And it's random every time. It's not going to get to 84 for me, is it? It's still successful if you're right 85% of the time or more, don't get me wrong. But I'm just trying to show you how quickly it changes. Let's go back to 50 and see if I can get 85. So here's yeah, 60% return on that portfolio. I changed the loss to 50. In this case here, yeah, we're up to 40,000 instead of 16,000. That's how much that can hurt you without controlling the risk in the proper level. That's why I've said it this way, Alton, is to, yes, target the 15% and the 85% success rate, knowing I have to control my losses, because if I let those go too far, and this is the same for the in-the-money bull call debits. If Terry was looking higher, if he was looking at 90% delta and expecting, let's say, an 8% return, and was going to be right 90% of the time, but still controlled at 50% losses, he's still going to be successful, but it's going to be slower growth because of the slow returns. So we're only up to 17,000. That's not bad. It's a 70% return on what you started with after 100 trades. But that's sort of the risk reward we look for. Okay. The risk we know we're going for, personally, again, we're going for that 85% probability with a 15% return. But we're going to do our own risk management and keep the losses to 50% of the maximum to match the trading plan that we want. Okay. And later on, we're not going to, I got to get to these other questions, Alton, but I'll send you a link to the 7 ways. We had this webinar a few weeks ago, 7 ways to manage a debit spread. And we'll talk about those in a moment. Now, while we're there, while we're here, I should just go back here for a second, just to illustrate the moneyness. Qutub had asked me a question last Friday. And he wanted to know, is it possible to make 1% per week with options? And we showed some examples of some of our default searches, weekly covered calls, how the monthly covered calls even averaged out over time to that 1% weekly return. Okay, so let's look at it this way, Qutub, from your previous question. If we were looking to make 1% per month, that's assuming, we were looking to make 1% per week. If your target was to make 1% per week and you asked if it was possible, we showed you some ways that were possible and some things that did show a 1% return per week in last discussion, with the reminder that past performance is no guarantee of future profits. But if you are averaging 1% per week, that would roughly mean that you're getting 4% per month, give and take with some winners and losers. So your question, quick now, Qutub, you asked, is what capital investment is needed to make $10,000 a month through options? 4% of what is $10,000? That's your answer. So that's kind of what we're looking at in this scenario. If your targets from the previous discussions that you and I have had, where you're trying to hone in on this 1% per week, or maybe 3.5% to 4% per month using options, now you just have to do that sort of, just take that number there and see 4% of what would equal $10,000 to 250, I believe, or 300,000. I think it's 250. Yep. So you would need, sometimes I can't do the easy math in my head. It's the harder math that comes simplest. So you would need $250,000 account hitting the targets that you've been asking about, a 1% per week, coming out to about 3.5%, 4% per month to get $10,000 a month in profit. Qutub, simple as that, based on our previous discussions that we've had.